true tax planning comes from proactive planning. So right now, we should be looking at 2023 and beyond. What are the things that I should be doing or not doing this year to make sure that I'm maximizing my tax savings? So I think the action item for all of our listeners is this year, when you're meeting with your tax person, getting last year's taxes filed, talk to them a little bit about what's coming up ahead for you for 2023 and pick their brain or, have a consultation on what are some of the strategies that you should be looking at for the upcoming year.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 374. Tax season is upon us, and we thought this would be a good time to discuss the number one most common costly tax mistake that real estate investors make. We'll also be discussing tax strategies to supercharge your wealth building and how to use a short-term rental loophole to reduce your taxes. Here with me today to strategize on our taxes is Amanda Hahn and Matt MacFarland, two CPAs and tax strategists who specialize in helping people use real estate to save massive amounts in taxes and keep their hard-earned money. They are the authors of the book on tax strategies for the savvy real estate investor and the book on advanced tax strategies, both released by BiggerPockets Publishing. Amanda and Matt, welcome to the show.
Thanks, Brian. Thanks for having us. Appreciate it.
Yeah, well, thanks for coming on just in time for tax season. I'm sure people listening to this, they're still at the point where they're putting off doing their taxes, and maybe this will help them. What's at the top of our list as real estate investors? What do we need to be considering this year as we fill out our taxes for 2022?
What I typically tell people is that it is a little bit too late now to plan for how to save on taxes for last year. Tax planning really should have been happening throughout the year. So, and not really just at tax filing time. But the good news for real estate investors is there are still a couple last minute strategies that potentially could help people reduce taxes, even though last year is already over. I think one of the biggest potential benefits now in looking at 2022 is the whole concept of bonus depreciation on rental properties.
Talk about bonus depreciation, because I thought that ended in 2022.
It's actually a common misunderstanding. So bonus depreciation, a lot of your listeners well aware, right? When we buy rental properties, we get to take depreciation on it, which is kind of, what we call or refer to as like a paper write-off, right? You get to expense part of your building every year against your cash flow and your taxable income for the rental. But with bonus depreciation, with certain type of assets, it actually allows you to write off 100% of that asset in the first year that you put it in service. So a lot of times that can be on furniture, fixtures, land improvements. But to your point, Brian, in 2022, we still had 100% bonus depreciation, meaning if you put say you put in a new pool or something in your rental property, you could expense 100% of it in the first year. Now, if you did that same improvement in 2023, the bonus depreciation rate drops to 80%, not 100%, but it's not zero, right? So it's still 80%, and then actually the rest of the remaining 20% in our example in that asset, that still gets written off over and for a swimming pool would be written off over 15 years. So you still get a little more than 80% in that first year anyway.
So you still get to write it off. It's just now it's going to take you 2 years to be able to depreciate it as opposed to doing it all in 1 year.
Right.
Yeah. And also like for the properties that were placed in service in 2022, you're still able to accelerate the depreciation if you haven't filed 2022 tax returns, which I think is most people, right? I mean, some early birds might have already filed, but most people, if you haven't already filed 2022 tax returns, you can still do accelerated depreciation and work with your tax advisor on claiming that 100% bonus depreciation if appropriate.
Going back to just the idea of depreciation, bonus depreciation lets you write it all off in the first year. And that's changed now. But There is still depreciation, and that's something that everyone should be aware of when they're investing in real estate. And that can be written off over a longer period of time. So you can still capture that. How is the bonus depreciation phasing out then? Because if it's gone from 100% a write-off to now it's an 80% write-off in the first year, is that going to get lower and lower as we go along?
Yeah, so it's right now it's scheduled to phase out. They drop 20% each year. So next year, 2024 would be at 60% and drops by 20% thereafter. Now, it's been around for a while, or some iteration of it has been around for 15, 20 years. So I wouldn't be surprised if, that law changes again. They bring it back in a couple of years before it phases out completely. That wouldn't shock me at all.
Isn't that why you should have a CPA doing your taxes so they stay on top of these things for you?
Yeah. And, I think, even I know that we've gotten huge benefits from this whole concept of bonus depreciation. And that's where you're seeing somebody who bought a smaller rental property, even $100,000 of building, where they're seeing up to, $30,000 of depreciation write-offs in that first year. But, even fast forward now to 2023, 80% is still huge. And even, next year at 60%, that's still very big. So what we're doing is we're taking a traditionally good strategy and making it, that much better with the whole concept of bonus.
I want to make sure we touch right away on the number one most costly tax mistake that you see real estate investors making.
Gosh, there's so many. And hopefully we're here to help people avoid those mistakes. But I think since right now we're kind of in the midst of tax filing season, one of the most common mistakes, not just for real estate investors, but I think taxpayers everywhere, is having a false sense that when you file your tax returns is when you can save taxes. People are always trying to say, oh gosh, I'm bringing my tax documents, my W-2s and 1099s to my tax person, and they're going to help me reduce taxes. But that's actually not the case at all. When you're now meeting with your tax person to file taxes for last year, all you're doing is reporting the facts of what did or didn't happen last year, right? Whether you sold a property, you bought a property, you reinvested in real estate, you did a 1031 exchange, you're just reporting what you did and didn't do. And the result is going to be how much taxes you save or how much taxes you owe. True tax planning comes from proactive planning. So right now, we should be looking at 2023 and beyond. What are the things that I should be doing or not doing this year to make sure that I'm maximizing my tax savings? So I think the action item for all of our listeners is this year, when you're meeting with your tax person, getting last year's taxes filed, talk to them a little bit about what's coming up ahead for you for 2023 and pick their brain or, have a consultation on what are some of the strategies that you should be looking at for the upcoming year.
What should we be looking at, and where are you helping some of your clients in that regard?
First step is kind of have that, have that open line of communication. So it's when things are going to happen, let your CPA tax advisor, your team of advisors know ahead of time what's going on. Hey, I'm thinking about selling this property. What should I be thinking about? From a tax perspective or just from any perspective, right? And just, and it can be as simple as just sending an email, right? It doesn't have to be a lengthy 30-minute, hour-long conversation.
But can you get specific with like a specific, here's what one of our investors was doing and here's how we save them taxes?
What most people come to us for is the tax planning side. Reason being, I think that maybe their tax preparer either doesn't offer the planning services or doesn't, is not well-versed in planning. So we had a client who were first-time investors, both in the medical profession, never owned any real estate before, and they came to us, and through our tax consulting program, we worked with them on the short-term rental tax strategy, which we'll talk about if we have time today in depth. So what they did, they bought 2 short-term rental properties, and they did all of the right things during the year to understand what their tax deductions are, capture those expenses, held their rentals in this scenario in an LLC, which was the appropriate legal entity for them, spent the right amount of hours doing the right things for the short-term rentals. They were able to reduce their taxable income from over $300,000 to under $100,000 by doing those right things. So, might sound like a huge tax savings to be reducing 2/3 of your income. But it didn't just happen by chance, right? Like I said, they did all the right things during the year.
What were those right things? Like, did they qualify as real estate professionals? Is that kind of where you help them save?
That's actually a common misconception that we hear from both investors and CPAs. So the benefit of the short-term rental loophole is that you don't actually need to be a real estate professional. You can utilize tax losses from your short-term rentals as long as you meet one of the 7 material participation hours requirements. Now, although there are 7, practically speaking, there's only 3 that we see investors use time and time again. The first one is at least 500 hours on your short-term rental properties. If you don't have 500 hours, you can go under an alternative, which is 100 hours and more time than anyone else. So here you're talking about how many hours of my cleaning crew spending, or my landscapers, or my repair guys, right? So I have to have at least 100 and more time than any of those people. If you still don't meet one of those 2 requirements, then you could go under the 3rd requirement, which would be any number of hours for Brian, as an example. But Brian's hours in the short-term rentals are more than everybody else combined. So it's a really powerful loophole, again, because you don't have to be a real estate professional to use those rental losses.
What specifically is the loophole when it comes to short-term rentals?
For long-term rental properties, you have to be a real estate professional. If you're a high income earner, right, meaning your income is over $150,000, you have to be a real estate professional to use rental losses against W-2 or other business income. One of the hurdles of real estate professional is you have to spend more hours in real estate than your job. So if you think about someone who spends 2,000 hours at their job, very difficult to also spend more than 2,000 hours in real estate, right? Whereas for short-term rentals, we don't care about real estate professional status. You just have to meet one of those 3 material participation hours that we talked about.
What other mistakes do you see real estate investors making when it comes to tax time?
Given tax time right now, one of them that comes to mind is the question of whether I should, as it goes to planning, multi-year planning, is whether I should file my returns by April or whether I should extend. Because, obviously, if you're expecting a large refund and there's nothing else going on, there's the incentive to file by April 15th, obviously. But a lot of our clients choose to extend their returns because it gives them that longer period of time to look back and see what 2023 is going to look like. So, for example, maybe they put some property in service in 2022. They're looking at, should I do a cost segregation study in 2022? But then, early in the year, they think 2023 is going to be a lower income year. So yeah, let's take the deductions in 2022. But if you extend and something changes in 2023, you have 9.5 months in 2023 to see what income is like in 2023. Maybe you figure out, hey, it's a higher year in 2023. I'm going to save those depreciation deductions for 2023. So that's one example where we see clients kind of, I don't know, I jump the gun is not the right word, but, file early when, maybe they strategically it would have been beneficial to kind of wait and extend.
Don't rush to get your taxes filed before the deadline. Sometimes it does pay to wait because you might see some things over time that would help you.
Right.
Tax treatment for individuals who own properties in their own name versus tax treatment for those who own them through a type of entity. What do you typically see, and is there a way that you prefer to see it?
From a tax perspective, there's not really, whether you own properties in your individual name or you own them in some LLC with you or you and a spouse, from a tax treatment perspective, there's no difference. Now, there might be a difference, you have a property you own 100% of versus you're investing in a syndication that you own, 1.35% of. But purely from a legal entity perspective, having that LLC own your own rentals is purely an asset protection strategy.
So it's more of an asset protection than a tax protection strategy then.
I mean, if we're talking with respect to rental income, right? If you're a landlord and you own whether single family or commercial real estate, the tax benefits and deductions are pretty much the same, regardless of whether you own individually, LLC, or partnership. One thing we tend to shy away from is having investors own rental real estate inside of corporations, whether it's S corporations or C corporations. Reason for that is that it comes with some potential tax issues and pitfalls and limitations, especially when it comes to this concept of we're always wanting to use rental real estate to create tax losses and utilize them. If you own rentals in a corporation, it could highly limit our ability to use some of those losses. So, typically LLCs are good, corporations not so good for rentals.
And you're talking about S corporations and C corporations. It's best not to own real estate through those. Better to own them through a limited liability corporation, an LLC.
Yeah, if we're talking about rental properties, yes.
One of the things I know has come up is that short-term rentals are treated more like a business in a lot of ways. So they're taxed more like a business rather than rental real estate. I'm sure we're kind of covering some of the same ground, but could you explain that difference in how short-term rentals are perceived?
I've never heard that question phrased that way. So all real estate is treated like businesses. And what I mean by that is, in the eyes of the IRS, rental income is business income, which means you can deduct the regular business expenses that a business owner might have. So whether it's travel or real estate education, business meals, right? So long-term or short-term, both treated as a business for tax purposes. The difference between short-term rental and long-term rental, a little bit is kind of what we covered on the loophole side, is that when you have long-term rental properties, it's more difficult to be able to use rental losses against your W-2 and other income for higher earners if you're not a real estate professional, right? Real estate professional meaning there's several hurdles to meet, but one of the most difficult ones for people who have a job is spending more time in real estate than their job. Whereas if you have a short-term rental property, you just need to meet one of those 3 material participation hours, and you can have a full-time job, be doing short-term rentals on the side, and be able to use those real estate losses from the short-term properties to offset W-2. So, it's not necessarily a difference of business versus not business. They're all considered business for tax purposes. It's just easier for someone to be able to use the losses against W-2 income.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com.
If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. When you talk about real estate professional status, I know exactly what you're talking about. And you're not talking about like a realtor or someone who's licensed as a broker. You're talking about something very specific, and it's used. I'll give you my interpretation and then you can take it from there. It's used when you have a high income earner, their ability to take losses gets phased out the more they make. But if they or their spouse or partner can qualify as a real estate professional, they're then able to take those losses. So can you explain that a little bit more for those who might be high income earners and real estate investors and looking for a way to shelter some of that W-2 income from taxes?
You explained it pretty well. So real estate professional is really a tax term. So it doesn't mean that you have a real estate broker's license. It has nothing to do with that. It really is, kind of in the eyes of the IRS, if you can qualify as a real estate professional or your spouse can qualify as a real estate professional if you're filing a joint return, and you generate losses on your return from your rentals, your long-term rentals, and those losses don't necessarily, we're not talking about losing money. We're talking about we've accelerated depreciation, maybe did a cost study to have more expenses than we have income. The goal being, can we use that net loss to offset our W-2 and other income? And if you can qualify as a real estate professional, then the answer is yes. And again, to qualify as a real estate professional, there's basically 3 criteria. You have to spend at least 750 hours per year on your real estate hours. You need to spend more time in real estate than you do in your other jobs. So as Amanda was kind of alluding to earlier, if you have a 2,000-hour job, you need to spend 2,001 hours in real estate. Kind of hard to do. But you could be working, maybe your spouse is working a part-time job. So if they were working 1,000 hours and they can get to 1,001 in real estate, then that meets that criteria. And then the third one, which is just equally as important, is you have to meet one of the material participation tests with respect to your long-term rentals. So, 30,000 foot level, kind of, are you self-managing it? Are you involved in the day-to-day stuff of taking care of your own long-term rental properties? If you can meet those three criteria and you have losses from your long-term rentals, you can use those losses to offset against all other sources of income from a tax perspective.
Someone who was audited by the IRS over that very thing 10 years ago, I can tell you that when the IRS does audit you over real estate professional, they want to see that documentation of every single hour, what it was spent on. In my case, I actually lost the audit because while my wife was very active in our portfolio, we weren't actually managing the properties. And they nailed us because we had a third-party management company. Long story short, we paid back the taxes that we would have had to pay. We were able to negotiate away the penalty. And then 2 years later, we sold the properties anyway. And so it was a year-long audit with really very little financial impact on me. But it did teach me that, when you do that, you have to have like documented hours and every T has to be crossed.
I mean, that's really the same, in the tax world. What I often tell people is, unlike our legal system where you're innocent until proven guilty, when it comes to taxes, you're guilty until proven innocent. So it's always up to us as taxpayers to be able to prove what we say we do, whether it's claiming hours on real estate or documenting expenses, right? That this particular expense was business related. The burden of proof is always on the taxpayer. But, what's really interesting about what you said, that you got nailed for, having property management company, everything's going to come down to facts and circumstances. So we have a lot of clients who have, lots of rental properties where some might have property management involved and others that they self-manage. What's great about real estate professional and just all the different hours requirements is you have the ability to group your rental properties collectively. So it's not uncommon for us to say, okay, we have an investor here with 3 out-of-state turnkey properties with management where they really do nothing with, but they also have a handful of properties locally or closer to them where they do self-manage or have enough hours to legitimately claim that status as well. So that's where the planning comes in, right, with your tax advisor.
The two of you wrote 2 books for BiggerPockets on tax strategies. Tell us why you wrote those books and what are some of the biggest takeaways from them.
The biggest reason we wrote the books, to be honest with you, is that we obviously are CPAs and we've read lots of different tax books. And a lot of times when you read those books, they're almost like textbooks, right? Where they're kind of, even to a CPA, they're kind of too technical, they're boring. And so we wanted to write a book that kind of told it more in a story format, right? It was a little more entertaining. So we've kind of used client examples. Now, obviously, we've changed the names to can protect the innocent, if you will. But we've kind of wrote the story wrote the book in a story format to kind of tell situations of what worked well, what didn't work well. What are the things to look for? And I think they like that. That's the way. Those are the kind of books I like to read. And so we kind of did it from that perspective to kind of educate people and, hopefully entertain them a little bit. But.
Yeah, I'll say the book is not for CPAs, although we do have a lot of CPAs who've read it and like it, but intention was not for CPAs, not a lot of numbers and calculations in the tax code like that. So it was all story format. Our goal really in writing the book was just to have the reader and, an average everyday investor be able to see what happens when it works well and really have better conversations with their tax advisor and ask better questions.
It is my strong belief if you are investing in real estate, have a tax advisor, have a CPA doing your taxes, even if you just have one property, because if you plan on scaling and growing, having that tax advice from the start is essential. Amanda, a question to you. What's your favorite hacker app?
An app that really interesting, since we were talking about real estate professional and short-term rental loophole, there's an app called Reps Tracker, REPS Tracker. It was created just 1 or 2 years ago to help people track their hours. So Brian, you were talking earlier about, documenting, tracking hours. Historically, we have our clients do it in Excel. One of our clients who is a physician told us Excel is no longer good. We got to get into the new age. And this doctor created an app called Reps Tracker, and now it's really taken off. It's one that we really like for our clients to use.
Matt, what about you? Hacker app?
But I'm even worse with technology than he is.
Something baseball related, I think.
Yeah, I was going to say non-investing. I do a lot of baseball coaching for my kids, and I spend a lot of time on YouTube looking at videos and things of that nature. So I'm always looking out for different tips and tricks. But I think that's, that could be the same for a lot of investors too, right? Is educate yourselves, find videos and things that are going to teach you something you haven't learned before. And I can't really think of an app off the top of my head, to be honest with you, but that's kind of the way I approach things. At least,
what's an app exactly?
Tell our listeners how they can find out more about you or get a hold of you.
I think the best place to find us is in our company website, which is keystonecpa.com. If some of the stuff that we talked about today was your first time hearing it, or if you just want to know, what is your risk of overpaying in taxes, we have a really great free downloadable resource called the Tax Savings Toolkit, where you can do a self-assessment on where you are in the risk profile of maybe overpaying in taxes and what are some possibilities. Of course, we talk a lot about the legal entity and real estate professional status within the tax toolkit. But if you are wanting just like daily tax tips, the best place to find me is on Instagram as Amanda Han CPA.
Thanks for coming on and talking about taxes just in time for tax season. I think you've given us some good advice. There's some good advice in there that will help save us money and possibly make us money over the long term. Amanda, Matt, I've enjoyed this conversation. Thank you so much.
Thanks, Brian. Thanks for having us. Appreciate it.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.